Hi there, welcome to Kneppy Invest. Another week, trading week done and dusted. Um, and it was a fairly active week for me. I'm just looking at what I did during the week. I sold out of 5 positions, not completely with 3 of them. And I actually did take some positions in 3 companies. And I'll talk about the trades I made during the week. But first, we're going to have a look at the performance of my 3 portfolios and also have a look at the benchmarks. And to be honest with you, since the start of the financial year, if you have been investing, more than likely you have done fairly well. And the reason I say that is because all 3 portfolios and 3 benchmarks are all over 10% since the start of the financial year. And here we have the performance of my 3 portfolios plus the 3 benchmarks I do track. The NDQ, which is the NASDAQ 100 ETF. Some people might say you should have put all your money into the NDQ. I actually wouldn't fight back against that. I wouldn't push back. If someone said to me they put all their money into the NDQ or the NASDAQ 100 ETF, how could you argue against that? You might say, well, you're not being diversified. Well, yeah, the best companies in the world are on the NASDAQ. Not all the best companies, but many of the best companies in the world are on the NASDAQ. The other 2 benchmarks I do track is the ASX Small Ordinaries, the XSO, and also the STW, which is the ASX 200 ETF. And to be honest with you, I more than likely would never, ever, ever put my money into an ASX 200, ASX 100, or ASX 50 ETF because the vast majority of those ETFs are in the banks or the holdings. What do you call them? The makeup of those ETFs are in the banks and in mining companies. In my opinion, banks and mining companies are not quality companies, not the sort of companies you want to own for the long term. However, you might say CBA and BHP are probably the better quality of those, but those are not the sort of companies that are going to give you market beating returns over the long term. Now, in saying that, STW is up 13% since the start of the financial year. It is beating the small ords, which is up 10%, but compared to the NDQ, up 21.7%. Even compared to 2 of my portfolios, the quality portfolio, which is the standard find high quality companies, put your money in those companies and hold them for as long as possible. That portfolio is up 16.6%. My small cap portfolio is up 16%. And I can imagine over time, I'm going to transition to only 2 portfolios, more like the quality portfolio, which would include some smaller companies that may not have reached that quality stage just yet. And I'm thinking like Audinate, those sort of companies, and definitely the technical analysis portfolio, or the technical portfolio, which is using a technical analysis strategy. That's up 46.2% since the start of financial year. And either that sort of strategy really suits me, or maybe I suit that sort of strategy, or I've just been really lucky. Now, over 8 to 9 month period, luck is less of a, not an issue, is less of a determinant on how well you're performing. So I have to understand that this strategy works really well for me. So maybe I shouldn't fight against it and really focus my intentions on this particular strategy. Otherwise, even if you tear it down, this strategy or these 3 portfolios and 3 benchmarks, and break it down into even the shorter time periods, the technical analysis portfolio is outperforming all the rest. Over 6 months, up 31%, 3 months, 22%, even 1 month, over 11%. And every single time I do this video, looking at the 1 week period, the tech strategy or technical strategy tends to do fairly well in only a 1 week period. Some of the other strategies can be quite volatile. For instance, in the past week, the NDQ was the worst performing out of these 6. In fact, in the past month, the NASDAQ 100 ETF is the worst performing versus the technical analysis strategy or portfolio up 11%. So I'm still grappling with this because when I started investing, I was all about trying to find value. I was a value investor. And the most important thing you can do, and this is not only true in investing, this is true in life, is be open-minded and willing to change your opinion or your mind on things. Too many investors are stuck on the one idea and they're not willing to do research or even open their minds up that there might be other strategies out there that suit themselves. And this is a problem I do have and have had for a few years now, when I have heard experts say the best strategy, the only strategy that works, is a value investing strategy, just like Warren Buffett. Although I would say that Warren Buffett is not a true value investor. And I have heard this. I have heard a few people say this, few experts say it's the only strategy that works. It might be the only strategy that works for them, but it's not necessarily the only strategy that might work for you. In fact, there could be other strategies out there that I'm not talking about that actually might work better for you than anything I do. So the most important thing when it comes to your investing life is find the strategy that works for you. And possibly the strategy that works for me is technical analysis. Now, I still like finding high quality companies, finding those small companies that might become giants in the future. So more than likely, I won't completely go away from that strategy. And what I'm thinking about doing in the future is putting my high quality companies in my superannuation fund, which I have complete control over. It's not an SMSF, but it's very close to being an SMSF. And the reason I'm thinking of doing that is because in my superannuation fund to trade, I have to pay $20 a trade, which is ridiculous. In fact, $34 a trade if I'm buying international companies or companies that are listed on international exchanges. Now, in my day-to-day portfolios that are not in my superannuation funds, I only pay $5 a trade. In fact, some trades $0. So what I'm thinking is I'm going to put all my high quality companies into my superannuation fund and trade using my non-superannuation funds. So I am transitioning to that right now, slowly, but I am doing it. And probably that's all I want to talk about this. So yeah, so 46.2% up since the start of the financial year. My goal is to get 50%. So unless we have a really bad last quarter of the financial year, more than likely my technical analysis portfolio will be up over 50%. Possibly it will do 3 times better than my quality portfolio, my small cap portfolio, and maybe almost 3 times better than the NDQ. And at this point in time, it's tracking to do or be upwards of 3 to 4 times better than the STW. In last week's video, I showed you the 5 best performing companies in each of my 3 portfolios. Now, let's have a look at the 5 worst performing companies in each of my portfolios. I'll talk about some of these companies. Now, we've got to have the quality at the top, small cap in the middle, and technical down below. So let's look at quality. What are the 5 worst performing quality companies or companies in my quality portfolio? You might not actually think right now that Nanosonics is a high quality company. I definitely argue that possibly Nanosonics has lost that right. In fact, I probably could argue that Nanosonics was never a high quality company and never should have belonged in that high quality portfolio. And you could even argue that Kneppy doesn't belong in a high quality company or quite high quality portfolio either. Both companies had disappointing half year results. I thought Nanosonics was definitely disappointing, but the company already hinted that their results were going to be quite bad, and that's why the share price is down 40%. Kneppy Pharmaceuticals, I can understand why the market has sold off on that company. Revenue was up a little bit, but profit was down, and the market hates when you have a high growing company and the profit is down from the previous corresponding period. Otherwise, I can't say anything bad about AUB Group or Corporate Travel Management. In fact, I'd probably say Corporate Travel Management is looking really good value right now for a company that I think is going to grow significantly over the next 5 years, but that's only down 2.3% since the start of the financial year. So it's being a little bit unfair to say that has been a bad performer, but it is the 4th worst performing company in my portfolio. The other thing I should mention, this does not include companies I've invested on international exchanges, simply because in ShareSite, it's just hard to draw up this sort of list. You might understand that if you are a shareholder person. So to be honest with you, apart from Kneppy and Nanosonics, there's no company within my quality portfolio that I'm disappointed about its performance. in the past year. Now onto the small cap portfolio. This is a little bit different. Um, Now, there is a wide range of performances when you look at the top performing companies in this portfolio versus the worst performing companies. And this is probably understandable because this is sort of a high risk, high reward sort of strategy, finding those small cap companies that might make it big in the end. Some of these companies won't make it. Some of these companies, more than likely, will go down to zero. So the 5 worst performing companies in my small cap portfolio are Sidev, Vection Technologies, Pointera, Highcom, and Ventura Health. And to be honest with you, right now, if I had to invest in any of these 5 companies, I would not do it. I do have high hopes for Sidev, and they were growing at a really good rate, and they're still growing, but my disappointment with Sidev is just their margins. They have no margins. Vection Technologies, they're into virtual reality, augmented virtual reality, and they have not shown me at this point in that stage in their life that they are able to reach any sort of scale. In fact, there was one, I think it was quarter, where their spending increased at a greater rate than the cash receipts. So I need to see proof that Vection Technologies can become cash flow positive and profitable, and they've yet to show me that. And I think the market is skeptical about that company as well. Pointera, just one disappointment after another. Now, they did have a good announcement on Friday, the 8th of March, after being suspended for a while. And I do think there is still a lot of potential in this company. They just have to realize that potential. And if the management can realize that potential, blue sky is possible for Pointera. However, I won't be adding to my position in that company just yet. In fact, the value of my holding in Pointera is down to $216. Yeah, it's fallen a fair bit. And Highcom, a really disappointing announcement a few weeks ago. Share price absolutely collapsed, down 68.6% in that company. And to be honest with you, no point selling out of that company just yet, because we have seen the share price of that company down a lot a few years ago, and then it rallied, and I should have sold on that rally. And Ventura had a really disappointing half-year results, way lower margins, increased competition. Share price has taken a massive plunge, down 70%. They still gave me a little bit of a dividend, but yeah, down 70%. And that's another company. If I had a choice again, I would not have invested in Ventura Health, even with the hindsight. Well, yeah, with the hindsight, definitely would not have invested in that company. But even before they released the half-year results, I would not have invested in Ventura Health anyway. Now onto the technical portfolio. And you'll notice there is only one bad performer in this company, in this portfolio, and that's DGL Group, down 31.7%. I actually did buy a little bit more on that. I'm a little bit nervous about that. But the way I look at DGL Group is, if you look at the net tangible assets of that company, it is higher than the value of the company right now. So the market is, or has punished this company to no end and might have overreacted. But we really haven't seen a major bounce just yet. So I'm a little bit nervous that there might be more news to come for DGL Group. And I'm willing to take my losses with that company because, to be honest with you, overall, in the success of the technical portfolio, it has done very little damage. I was surprised. I had a look. If I deleted DGL Group and compared the performance of the technical portfolio versus the performance now, there wasn't much difference. So probably could sell that. I'll sleep better I was going to say I would sleep better at night, but I sleep perfectly well every single night. Next worst performing company is Integrated Research, but I only bought Integrated Research on the Friday. So that's not concerning for me right now, only down 1 cent. MoneyMe is another position where I am thinking of selling, just like DGL Group. I'm not confident in that position just yet, only down 0.6%. So you might be saying, well, give it a little bit more time. But the share price looked like it was going to rally, got up to above 10 cents, but it has fallen back and volume has really decreased over the past few weeks. So less confident in MoneyMe. And the other two companies, Bank of Queensland has finally gone on a rally. I've been waiting for this company to go on a rally because all the other banks have rallying hard, just not Bank of Queensland. And finally, it might be breaking out. And Ticker Data, I bought Ticker Data on the Friday, the Thursday, I believe, and it's up 1.5%. So I've got to give that company a little bit more time. And all right, I'll say right now, The time I'm giving Dicker Data is 2 weeks. In 2 weeks, I would not be owning Dicker Data. Either it's gone up by more than 10% or just on 10%, or if it hasn't gone up 10%, I'm selling no matter what in 2 weeks. Probably the last thing I should mention is all the transactions I made during the week. I actually don't have a slide for this. So I actually did take profits in Zip and email payments. I did not completely sell out of each position. I have maintained a little bit in each company. And email payments, there is a possibility with that company that I might actually enter back into that company because the share price is hovering around $1. And if I see some strength in the share price, particularly if it gets to say $1.05, that will be a really bullish move for email payments. But there's also the possibility the share price might drop to below 90 cents. So what I'm looking for now is confirmation that there is no more selling, and I want to see a breakout. So that's what I'm waiting for now with email payments. So I have no confidence either way with that company, and that's why I have taken profit. I sold at a small loss with AccuSensus. Two bad announcements in a few weeks has seen that share price of that company drop below 70 cents, and that was my sell point, 70 cents. So I've got to listen to my rules and listen to my strategy for each trade. Yes, I have a strategy for each trade, and AccuSensus sell point was below 70 cents. And Duratec, the chart for Duratec looks really bearish. Definitely not bullish anymore. The company's shares were sold off when they released their report. I had a look at the half-yearly report, and I decided on the back of the half-yearly report, I would take profits in that company. And the thing I was thinking about possibly doing was transitioning Duratec to my small cap portfolio. However, after doing research and looking at the half-year reports, I did not want to own that company for the medium to long term. And it's just mainly the sector they're in and a few red flags I did find in the half-year report. Now, the buys during the week, I did actually the other sell I made was Demerix. I should actually mention that I did not completely sell out Demerix. I only sold out a portion of that company because the company is looking for some results in the next week. It's a binary outcome, so there is potential share price might rally 50%, 100% on the results, or it might go down 50% or so. So I decided to take my profits in that company, not completely, just in case the results are good. And if the results are good, I am willing to go back in and add to my position in that company. Now, the three buys I did make during the week, CUE Energy. There is a 2-cent dividend coming for shareholders in that company in about 2 weeks. There is a potential I might take profits before that. I'm already in profits with that company. Integrated Research, I've already mentioned that company. And I think I'll show you the chart for Integrated Research when I do my technical update video tomorrow. Release that on the 10th of March. And there is a reason I have bought some shares as a trading position in that company. And Ramsay Health, a beautiful breakout occurring with Ramsay Health, a company I owned about 10 years ago and am now back to owning that company for maybe a short term, possibly a longer term if the chart turns really positive. So that's the trades I've made during the week. If you don't have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.